Ever feel like mortgage rates are like a roller coaster ride? One minute you're cruising at a comfortable 3%, and the next, you're rocketing sky high to a dizzying 8%. Hold on to your hats, folks. So buckle up, dear viewers, and let's dive into the thrilling world of mortgages. Now imagine you've just acquired a property worth roughly $500,000. Pretty cool, isn't? But this is just the start of an interesting journey. Let's travel back in time around 18 months when the mortgage rates were at a cozy 3%. With a loan of $500,000, your monthly payments would be nearly $2,108. Quite reasonable for your ideal home, wouldn't you say? But brace yourself because the financial ride is about to get exciting. Jump to the present day and mortgage rates have shot up to an incredible 8%. Your monthly payments have now escalated to $3,677. That's close to double. Now let's discuss the kind of income you need to accommodate these payments. Earlier, with a mortgage rate at 3%, you'd need to pull in about $5,855 a month. Pretty feasible for numerous middle-income earners, you agree. But as the rates climb to 8%, the scenario drastically shifts. To handle the increased monthly payments, you'd need to be pulling in a breathtaking $10,213 a month. That's equivalent to needing a second job. So, what's the implication of all this for our middle-income earners? Well, it's not completely pessimistic. It means that careful planning and budgeting will become even more vital. It means actively searching for the most favorable rates and considering fixed-rate mortgages to secure lower rates. It means looking into other options like downsizing or contemplating a more economical area. And for those pondering about owning their first home, it means saving more for a down payment to lower the loan amount, or waiting for the rates to fall again. Essentially, it's akin to engaging in a game of financial chess, where each move is significant and could lead to checkmate or a stalemate. It's a tough game, but with a thought-out strategy, it's definitely conquerable. So, unless you've discovered a money tree, these escalating rates may present a challenge. But don't forget, challenges are merely hidden opportunities. So fasten your seatbelts, plan your strategy, and gear up for the journey. But what about our acquaintances bringing in roughly $40,000 annually? Let's have a look. Picture this. You're at an upscale car showroom and a gleaming Ferrari has caught your attention. You start to fantasize about the rush, the exhilaration, the jealous glances from the people living next door. However, upon checking your wallet, you realize you're operating on a fiat budget. This is somewhat the situation for those earning around $40,000 in the face of present mortgage rates. A year and a half ago, with rates at 3%, the monthly installment on a loan of $500,000 was approximately $2,108. This demanded a monthly earnings of nearly $5,855. To be honest, that's already quite a challenge for our around $40,000 income group. Yet it remained a feasible goal for a few. Fast forward to the present, where mortgage rates are officially over 8%, the identical $500,000 loan currently demands a monthly installment of $3,677. That's akin to upgrading from a Fiat to a Ferrari in terms of budget. To be eligible for this, banks would require a monthly income exceeding $10,200. Now, for those adept with numbers, it quickly becomes clear that this is quite above what our friends with an approximate $40,000 income are bringing in. So, what's the significance of this? The aspiration of owning a house might be drifting away for some, but remember, this is merely based on a $500,000 loan. More economical alternatives are available. Additionally, there exist programs and grants aimed at aiding lower-income earners to step onto the property ladder. And let's not forget, mortgage rates may resemble a roller coaster more than a Ferris wheel, but that doesn't imply they only escalate. They can decrease as well. So if you fall in this income category, don't lose courage. Continue saving, continue planning, and who knows, you might end up owning that Ferrari after all. Thus, for our of approximately $40,000, it's somewhat like attempting to purchase a Ferrari on a Fiat budget. Moving up the ladder, how do our earners making between $40,000 and $80,000 fare? Let's find out. Visualize you're hiking up a steep hill. The terrain is uneven, and you're carrying a heavy backpack. You're coping, but it's quite the workout. This is the reality for those with an income between $40,000 and $80,000 a year, grappling with the new mortgage rates. A year and a half ago, the path was less challenging, the incline less steep. Mortgage rates rested at a comfortable 3%, putting monthly payments on a $500,000 house just above $2,000. With an income of around $60,000 a year, that's a manageable climb, but presently, the path has shifted. Incline is more intense, the rocks more jagged. Mortgage rates have more than doubled, escalating to 8%. That same $500,000 house now requires a monthly payment exceeding $3,600. That's a formidable climb. Sure, our climber could settle for a less expensive house, but that might mean sacrificing on size, locality, or conveniences. And we all know how hard it is to compromise on our dreams. Or our climber could opt for a longer mortgage, perhaps 40 years instead of 30, but that equates to more interest over the span of the loan. It's similar to adding more weight to the backpack. So, what's the best course of action for our climber? They could concentrate on diminishing their debt, enhancing their credit score, and saving for a larger down payment. These measures could secure a lower interest rate, making the ascent up the mortgage hill more manageable. But let's not sugarcoat it, a challenging journey. Our climber will need to work diligently, make sacrifices, and remain determined. It's akin to trying to fit into a pair of high-end jeans after indulging in a 3-course meal. Doable, but far from comfortable. For those between $40,000 and $80,000, it's like trying to wear high-end jeans after a rich 3-course meal. Doable, but far from comfortable. Now, for those pulling in a salary somewhere in the vicinity of $80,000 to $120,000, the landscape may appear slightly altered. Let's unearth the specifics of that. You're occupying this income range, correct? You're doing rather decently for yourself, not swimming in a sea of cash like Scrooge McDuck, but you're not exactly counting every penny either. Yet, with these new mortgage rates, you might be feeling the financial squeeze a tad more than you'd prefer. Now let's analyze this situation from the perspective of a $500,000 loan. A year and a half back, with a 3% rate, your payment was a manageable sum of $2,108. Now with the rate at 8%, your payment catapults to $3,677. That's a significant jump, and your monthly earnings need to assimilate this hike. To comfortably shoulder the new payment, you'd need to be raking in more than 10 grand monthly. Now I'm not sure about you, but for the majority in the $80,000 to $120,000 bracket, that's a bit of a stretch. Let's illustrate a scenario here. Visualize you're scaling a mountain and suddenly the gradient of the mountain becomes a whole lot steeper. That's essentially the situation at hand. You're neither at the base of the mountain nor at the peak, but somewhere in between, and the ascent just got tougher. However, don't lose hope. It's not a complete financial apocalypse. There are tactics to maneuver around this terrain: budgeting, saving, exploring varied loan options, or even pondering over smaller properties. It's about adjusting to the climate. And bear in mind, you're not solitary in this expedition. There are millions traversing the same steep mountain. It's akin to being in a large, slightly rattled, finance-oriented family. So for those earning somewhere between $80,000 to $120,000, it's akin to being the middle child. You're neither neglected nor in the limelight. But fret not, there's a silver lining. You still secure a seat at the adults' table during family congregations. Hold your head high, and let's conquer this mountain in unison. And finally, let's take a look at how our top earners, those making approximately between $120,000 to $125,000, are faring. Now, these individuals typically find themselves in a financially secure position. They can indulge in a few luxuries now and then, and might even be thinking about venturing into real estate. However, with the recent upsurge in mortgage rates, how does that impact their financial strategy? A year and a half ago, a $500,000 loan with a 3% interest rate would cost about $2,108 each month. That's a substantial sum, but manageable for our top earners. But currently, with the mortgage rate standing at 8%, that monthly expenditure shoots up to $3,677. That's a staggering 65% increment. Now, don't misunderstand me, our top earners can still afford it, but it signifies they'll have to cut back a bit. Perhaps forego that extravagant holiday or postpone buying that glossy new sports car. After all, money doesn't sprout from trees. Or does it? I'm still examining that theory. To provide some context, with the revised mortgage rates, banks would wish to see a monthly income of roughly $10,213. That's quite a jump from the earlier requirement of $5,855. But let's not overlook, these top earners have endeavored tirelessly to reach their current position. They've ascended the corporate hierarchy, shattered glass ceilings, and likely even acquired mastery over office politics. They are tenacious and flexible. Yes, the heightened mortgage rates may pose a challenge, but it's one they are equipped to surmount. Keep in mind, a higher income doesn't directly equate to financial security. It's about how effectively you manage your finances, how you adjust to fluctuations, and how you plan for what lies ahead. So, to all the top earners listening, keep your spirits up and your purses tighter. For our top earners, it's akin to possessing a golden ticket, but the chocolate factory has just elevated its entry fee. If you're finding this roller coaster ride enlightening, don't forget to hit the like button and subscribe to our channel. It's a small act, but it means the world to us at All Street Financial. It's like giving a thumbs up to the conductor of the financial roller coaster, reassuring us that we're on the right track. When you subscribe, you're not just joining a channel, but a community that navigates the ups and downs of the financial world together. You'll be the first to know when we upload a new video, and you'll never miss out on a crucial update or a savvy money tip. So go ahead, hit that like button and subscribe. Because when it comes to understanding the financial world, every bit of information can mean the difference between a bumpy ride and a smooth journey. Your support helps us keep this roller coaster running smoothly. And that's a wrap for today's thrilling ride on the mortgage rate roller coaster. We've navigated the peaks and troughs of rising rates and how they impact all income brackets. Thanks for sticking with us. Join us next time as we dive into another exciting financial adventure. Until then, keep your seatbelts fastened and your sense of humor handy.